You.
Thanks, Mark. Yeah, guys. So really appreciate everybody making the time today. We've got an interesting conversation between Marcos Veramis and Andrew Chen. Just for a little bit of background, Marcos is at Evanston Capital Management, which is more of an institutional multifamily office, really founded by the former CIO of Northwestern University. Marcos joined Evanston from Cambridge Associates, where he wrote the white paper on why institutions should be allocating to crypto and blockchain. So definitely a thought leader in the space. Joining him on this fireside chat is Andrew Chen from Lockheed Martin's pension plan, who's really spearheading the initiative there to kind of really get his arms around, what that institution is how they're incorporating crypto and blockchain into their portfolio. So kind of thought it would be really helpful for folks, because I know we talk about it a lot, as Stephen kind of with a great intro and segue into this chat. How are these technologies going to disrupt the way that we operate and the way we invest going forward, and how should we be thinking about them from an institutional perspective in terms of portfolio management. So with that, I'll kind of hand it over to Marcos and Andrew and kind of let you guys take over. I don't know if there's any slides or any kind of points that you want me to kind of put up, but obviously the floor is yours. And for now, well, yeah, we can just leave it there.
Thank you, Joe. Thanks everyone very much. It's a pleasure to be here. I think the way we want to do this with Andrew is, we have a lot to cover in an hour, and it's going to be hard because we're going to touch upon, why is this an important technology, all the way to, ways to invest and what makes sense in terms of allocations, current events with respect to crypto and so on. So in an hour, we'll try to do our best to touch upon everything, because we could have a separate session for each. But the way we thought we would do this is we would play, because it's just the two of us, I'm going to ask Andrew some questions, and then he's going to ask me some questions, and we're going to turn it into a discussion for each of these questions. So of course, if anybody wants to stop us and ask anything, please do. We're also going to allocate 15 to 20 minutes for Q&A in the end. And with that, I'd like to ask Andrew to give a bit of his background, and then I'll give you a little bit of my background, and then I'll ask Andrew the first question.
Sure, great. Thanks everyone for taking the time to join us. It's definitely very topical in what's going on. I guess my background real quick. I'm part of Lockheed Martin's corporate pension, and just very upfront. I've been doing a lot of work in the space, but it's to be very clear, it's not like we've taken a very kind of top-down strategic initiative to dive deeper. I mean, frankly, I outed myself as the nut job of the investment team, but I think with good reason. So my quote day job is focusing on the hedge fund portfolio and being an allocator in that space, and that's something I've done for, I guess, give or take 15 years at this point. So hopefully there's a little bit of credibility. And the way that I kind of got involved was this kind of maybe the least interesting story. I basically studied my way into understanding what was going on. You have a lot of folks who either a friend introduced them, or they just somehow had a kind of a light bulb moment. I think real quickly, it's a super quick background. I've messed around with code myself, Python, JavaScript, and all that kind of stuff. I would never say I'm as proficient as folks who do that for a living, but I think that was a good entree into understanding sort of the open source software kind of ethos, which pervades a lot of the space. It was a chance meeting with one of the funds that kind of gave me an opening to dive deeper. And the other thing is, I've noticed, in our world, is if we as allocators and investors, if we want to learn more about something, usually we just call up our coverage at said investment bank, or maybe some of our managers, and say, hey, give me the skinny on this. But there really isn't a way to do that. Maybe it's going to change, but for now, I think most of the bank research is pretty much hit pieces, to be quite frank, against crypto. And so it took a lot of firsthand, diving headfirst into Twitter, Medium, Reddit, white papers, code, and I kind of came out of it, and we'll touch upon it. You know, crypto is misunderstood, but I came out the other side realizing that this is something that is going to impact all of us. So, anyways, that's kind of where I started the journey, and I'll let Marcus kind of give his more interesting background.
I'm not sure about that, but yeah, Joe gave you a little bit of my background. I mean, from my professional perspective, I started looking into crypto at Cambridge Associates back in, at some point in 2017. Now, what prompted me to do this was a personal interest in the space, and I'll touch upon that. But what we did is, we started exploring the space in 2017 and early 2018, right after the bubble burst. And we met with, 50, 60 managers, key managers in the space at the time. We read through reports, we interviewed people, we read Medium articles, and we tried to decide whether this was something worthwhile pursuing further. And so with that work, in early 2019, we released a report that basically said, in summary, and it's a public report, you can find it, that this is a really interesting technology. It's very early, but it could be transformational, and therefore investors should start looking at it now with an eye towards the long term. And from there, we did some due diligence on a number of funds, and I'd say a handful, just a small number of clients of Cambridge Associates actually invested in some of these funds. So with that, I can go back now to how I got interested in this. I grew up in Greece, and I lived through the whole Greek crisis from abroad, of course, but I had my mom there, friends, and so on. And what hit me was the point when the bank accounts were basically, capital controls were basically set on bank accounts, and people couldn't really send money abroad, they couldn't take money out, and so on. And that followed, a very substantial write-down of government debt. So with that, I bumped into Bitcoin, and I realized that there is a new method, a new way to actually transact value in an internet native way that is completely independent of the financial system. So that caught my attention I'm just giving you kind of my personal context here. So here we are today, we're continuing doing the work. The space has evolved, a lot. We've moved from the ICO bubble to the birth of decentralized finance today. But with that said, I think it's still very early on. And with this background, I think I'm going to jump to the first question now, and I'm going to ask Andrew. And of course, Andrew, you can ask me, tougher questions if you'd like. But why do you think this is an important technology? A lot of people say it's not, it's not really useful, right? We have the financial system, and we have, the internet platforms, Google, and so on. We work really nicely with them. So why is this an important technology in your view?
Well, maybe I'll tackle that with an analogy. And so, kind of answering your question a little differently, but I promise I will hit upon the key points. But when the internet first came about, like if you were to see a screenshot of Sir Tim Berners-Lee sort of rendering of the internet back in 1994, and you said this was going to be transformative, and any business that doesn't have a website or some kind of web access or mobile access at this point is going to be in the dust. You'd be like, this thing looks clunky, it looks like Minesweeper, like what the hell? And as we kind of evolved and people started to see, oh wow, you can put newspapers on the internet, you can read it anywhere and you don't have to print it anymore. That was sort of like the first order perception of how this could be transformative. But what really was transformative was ad retargeting, because you could basically tailor make advertisements to individuals, and then the comment section, which then devolved, if you will, into social media, for better or for worse, has been very transformative and impactful. So I think the thing is, if you're just saying, oh, well, we have bank accounts and, we can access the financial system, I would sort of tackle that from two directions. I'm going to take a wild guess that everyone on this call is fortunate to, have credit, have access to financial system, have access to, ways to invest in pretty much anywhere we want. But most of the world doesn't have that. And if you were to sort of rip the hood off of, or kind of look at the plumbing of the existing financial system, it's pretty clunky. And it works for now, but and so I'm not saying that, okay, tomorrow, let's say the Ethereum network and DeFi is going to upend all of that in a matter of seconds. But I think how this probably happens is through more crypto native applications that come through. So for instance, stuff like streaming money, or micropayments, or machine payments, or stuff like that. Just sounds kind of sci-fi, but stuff like that could enable new business models. But kind of to go back to your original question before I went off on my own tangent, I think this is important, and you hit on one of them, which is sort of seizure resistant. But seizure resistance, and that I don't want to necessarily go down too dark of a path, but in a world where we have zero rates and declining trust in institutions, having a way to sort of preserve your wealth may become something that we've not had to take seriously for a long time. But kind of, I've used the phrase with some friends that Bitcoin is if like the internet and gold had a baby, it'd be Bitcoin. And so the ability to take that anywhere, I think is pretty powerful. And then there are other kind of, like you said, we could go down, we could spend a lot of time talking about all these topics, but reworking the plumbing of the financial system to enable it to be more decentralized and democratic, to kind of be very stylized about it. And then also the privacy aspect, all the big tech has monetized the use of our data. And taking some of that back for the individual would be definitely a change in the shift in paradigm. I kind of tackled a lot of stuff, but obviously would be interested to hear what you think as well, Marcos.
I think you touched upon everything really.
Okay.
I mean, I'm gonna maybe mention some of these. Maybe I'll repeat a couple of these things, but the way I've thought about it, it's a broad, far-reaching technology, and there are numerous things that it does. So the first thing that it does is that it turns value into a protocol. So with the internet, we had the decentralization of information, which really transformed the world and business models. I don't need to go into that, what happened there. But here with the decentralization of value, where value can be created and transacted in these protocols that nobody owns, but that can be sustained on their own and be secure, creates a new playing field for potentially new business models. It allows for new digital primitives. Very simple example, Bitcoin store of value, the simplest one, first the blockchain, but also digital goods. And people are talking now about, digital paintings, for example. You can imagine a world where unique digital paintings living on a blockchain can be bought and sold by people. That's not something that can happen now in the digital world, because files can just be copied. There's no scarcity. But with blockchain technology, you've created a protocol, a method to create scarcity and create certain standards that deliver scarcity. We can go into that further, because there's a lot going on in terms of competing protocols right now. So it's uncertain where this all will land. But that's one thing. The other is, decentralized finance is obviously springing into existence now. It's global. It allows people anywhere in the world with an internet connection to borrow and lend and use derivatives and take synthetic bets of all sorts, and they don't need to have a bank account. There may be 1.7, I was reading, 1.7 billion people globally with no bank accounts. So there's, it allows for access, but importantly, it allows for innovation, right? You can't go now into Bank of America's, computer system
No.
and start like playing around to create new financial products. You can't do that. But in decentralized finance and open protocols, you can use existing innovations to enhance them, combine them, and you can create, honestly, it's early, but you could potentially create very new financial instruments. And so it creates a level playing field for innovation. You touched upon web models and advertising. With the creation, with the fact that we can now have value living on the internet, you can append these business models that rely on advertising and cause all these indirect, perverse incentives. We can talk about Brave, very new project later on, a way to basically, pay people for content, get paid for viewing advertisements rather than being flooded indirectly with advertisements you don't want to see. So a redesigning, let's say, of the web services of today. Cost savings, by creating this kind of coordination, you can get rid of a lot of back office and overlaps and, 100 sets of books that try to that people try to reconcile with each other and takes tons of time, man hours and energy. And finally, I would say that what we're seeing, and also with DeFi, is that it's a very interesting new way of bootstrapping and growing networks, right? So Compound is a case in study with DeFi where they released their Compound governance token. The idea is to make this protocol, this money market protocol, decentralized, and the governance token is basically distributed over time to the people that use the protocol. And when that token was released, all of a sudden liquidity and borrowing and lending on Compound kind of went up 5, 6, 7x as it created this flywheel. So those are just some of the things going on. And as I said, if it sounds complex, it is, because it's probably broad reaching.
Oh yeah. Yeah, no, it's as you and I and anyone else who has just tried to wrap our heads around the space, it's there's a lot to tackle and it's constantly changing. So it's sort of like running at full speed to stay in place.
And with a lot of bad actors and terrible ideas and scams and the Wild West, but that goes with the territory, right? It's an open playing field.
Right. And I think just to kind of hammer that point home, I mean, no one's saying those are good things, and I think that is that unfortunately gets most of the airtime when you discuss crypto, because it's clickbait. But I think that all the stuff that is happening, all the innovation and all the interest and the next generation of technical talent flooding to sort of rebuilding the internet is going to be a much more powerful force. So maybe along those lines, kind of rolling through, Marcos, you're pretty well positioned, given where you sit now and where you sat before. Why and how are institutions interested in getting exposure, and how are they doing it? Would be interested to hear your perspective, since you've probably spoken to a lot of these folks.
Yeah, that's a great question, and it has evolved a lot over time, let me say, because it started back in 17, 18 as, the vast majority of institutions thought this was just an area that was of little significance at best, and, that there were so many frauds and terrible ICOs was kind of the dominant narrative then. But I think with Andreessen Horowitz going into the space all in with a dedicated fund, and Chris Dixon, one of its senior partners, they're going in full time in 2018. It started occurring to folks that, hey, maybe something really interesting is going on here. And so if we fast forward to today, I think the folks who have actually decided to explore or invest in the space are doing it from a venture perspective. And what are they thinking? They're thinking, we had the internet that took you know, a couple of decades to evolve, but you know, started you know, with the internet protocol in the late 70s, and you know, with HTTP in the mid 90s, and the first web browser, and that was a game-changing time where the information became decentralized, right? And all the new business models were built on top of it. So their idea now is that now we have value protocols that are being built. They're competing with each other, of course. A lot of them are gonna die, but the idea is that we're in the early stages of the internet in some sort of way, and that it's worth taking some bets, even though we don't know the exact direction it's gonna go. It's as if you are, like, let's say in the early 90s, and you're thinking, or in the mid 90s, and you're thinking, well, let me invest in this space. I have no idea how this company is gonna monetize itself, but something's going on here. And I think it's a similar perspective. So the institutions that have gotten in I think are viewing it more kind of as a subset of venture capital, where most of the cutting edge innovation is happening, but also where the risks are extremely high. And you know, they're taking a broader perspective. They're taking, you know, Bitcoin is one area, you know, it's one protocol. It's kind of more like digital gold, but that's a feature of Bitcoin. They're thinking of Bitcoin. They own Bitcoin, but they are also thinking of these Web3 models, and they're also thinking of new types of protocols, stable coins, decentralized finance, and they're trying to kind of place bets with managers that they think are key. And of course, as you know, Andrew, you know, the past year and a half, there have been a lot of a number of spin outs from good, you know, brand name VC funds that are dedicated to crypto, and that's where investors are navigating at this point.
Hey Andrew, it's Rob. I got your note. I have just a quick question, if it's possible.
Sure.
We actually bought a business from Lockheed Martin, Mountain Gate Systems, a few years back. But because you guys are a defense prime, are you more apt to get into the sector because of the defense or cyber areas of of Lockheed, vis-a-vis sort of a typical multinational? So the question is, are the defense companies getting more into this, or is this more portfolio allocation for Alpha?
The short answer is, well, I have not heard any kind of top-down initiative from corporate. So it's kind of driven by me, and now I've kind of roped in a few colleagues to kind of build our knowledge base within the pension. Yeah, that's sort of the short answer. But hopefully there's more to do there for sure.
Thank you.
Yep.
Let me turn the question back to you, Andrew. Why are you interested, and why do you think, you know, you've spoken with a lot of these managers? I know you've spoken with many institutions.
Yeah.
Trying to figure out the space. Why do you think they're interested?
You know, I think just to kind of build on what you were saying, it's if you saw the potential of getting in early in, you know, the birth of the consumer internet, maybe there's another bite of the apple that you can take. And I think that seems to be what motivates some of the first folks that I've spoken to that have gotten involved. But you know, like this is very different. This is kind of a complete paradigm shift. So, you know, like I guess I can sort of, maybe I can speak to my own kind of motivation and kind of build it out. But you know, it's you don't see a lot of stuff that comes along that could kind of upend the way we know things. And a lot of times when we speak about our early days of learning of crypto, it's called falling down the rabbit hole, and that's very true. It's Alice in Wonderland reference, also maybe a Matrix reference tangentially, but, understanding kind of the underpinnings of the internet, society, monetary policy, and all these things. It's sort of this weird cross discipline study, and it kind of there are totally different ways to take it. Sort of reorganization of labor and capital, and these are sort of like first principles kind of re-underwriting. But anyways, I don't want to get too philosophical right now. But it's a space that I guess I just found so complex but so powerful and misunderstood. And frankly, I want us to be early in that conversation rather than being late. That might fundamentally be it.
Got it. So there's a question that came in, which is, I think, is a really interesting question, and we touched upon it very briefly. But how should one invest? There are venture capital structures. I mentioned that most institutional investors are looking at the space through that lens, the VC lens. But there are also quant products. There's index funds. There are Bitcoin funds. You can buy Bitcoin directly. You can buy Ethereum. You can go to Coinbase, open up an account, and buy Ethereum and do it on your own. The question is, how should people be investing in this space? There doesn't seem to be a unique model here. It seems to be all over the place. So how do you think about that in terms of implementation?
I mean, I do think, for what it's worth, most people will stick this in the VC bucket. A function of just kind of, frankly, risk reward and the tech heavy elements of it. But as you said, there are a few ways to tackle this. One thing I would throw out before I dive into all the ways is, I think there's still an open question in terms of what is the right fund structure to even get access, because you have stuff that is liquid. I don't know if it's really a good thing or bad thing if your seed and Series A portfolios were traded on a 24/7 daily basis, the kind of volatility you would get. But that's, in crypto, that's just what it is. So anyways, obviously you've mentioned the VC space. That is, I think that's a natural fit. These are kind of longer life, or standard VC 7, 10, 13-year potentially vehicles. I think that does make sense in terms of being able to nurture and work with some of these protocols and groups and projects to build something out versus just flipping. There's sort of a lot of, well, not a lot, but then there are quote hedge fund structures, in that they're liquid, so maybe like 1 or 2 year locks, and then quarterly liquidity, and so on and so forth. And those, from what I've spoken to, many of them are more or less long versus long short. So it's sort of because it is kind of a nascent space, and going into next year, we can talk about why, but going into next year, no one really wants to be short because you could get your face ripped off. So there's that group, and that might be a bit suitable for folks who are looking for a little bit more liquidity and frankly, like instant exposure versus a deployment cycle. And then there are quantitative strategies, and these are they run the spectrum. Some folks approach it as we're agnostic to crypto, we don't believe it or disbelieve it, but it's a highly inefficient space from a market perspective. So we're going to mine that alpha. So you can have CTAs, you can have market making shops, algo trading, all that kind of stuff. I think some of these tend to be capacity constrained, but nonetheless, you can generate some good non-correlated alpha. And then obviously there's a whole suite of beta products, if you will. No Bitcoin ETF yet, but a lot of de facto vehicles out there. And then other kind of more private vehicles to get access to different stuff. But those at the top of my head are kind of the suite of products out there from what I've seen.
Yeah, yeah. No, I think you covered everything. I'd say, you know, the way I think about it is you start from the liquidity spectrum, right? You have equity, think of companies like Coinbase or other types of infrastructure providers for crypto that are equity businesses, traditional business models with cash flows. And then you go all the way to the most liquid assets like Bitcoin. And you have this liquidity spectrum, and you know, what can you do with it is the question. You know, on the more liquid side, you can do trading strategies as well. You can buy and hold, you know, and take a venture perspective and buy and hold some of these protocols, but you can also do trading strategies. On the less liquid side, obviously you can't do that, less and less, you know, as you go down to equity, and you need more of a venture capital approach. So what I've seen for the most part have been, you know, I've seen venture funds that play the whole field. Within a venture structure, they have equity, they have pre-launch tokens, they have Bitcoin, and they allocate between the three areas, you know, depending on where they see the opportunity. There are hedge funds that also do the same, you know, with long lockups and maybe side pockets for the equity deals. And then you can go all the way to actually, you know, owning some of these protocols yourself, the way you would own a Google stock or, you know, Facebook stock. You could own Bitcoin yourself, or you could delegate the entire crypto allocation to one of these managers. A clear business model hasn't been developed yet, but I would say that the two ends are, you know, there's the liquidity spectrum, and then there are the quant funds and the more buy and hold venture oriented funds. That's kind of the broad like universe right now. The institutional investors have been mostly doing the venture buy and hold types of funds, thinking that this is more of a venture bet where you have some liquidity in certain occasions and you can adjust your exposures or get in and out, rather than the quant, because that, as you said, is less scalable at this point.
Yep. And you know, we one thing that definitely pops up whenever you know, I speak to folks about this is you know, why aren't, you know, your brand name VCs getting into the space, or are they, or, you know, kind of given your perspective, why, basically, like, are there barriers to entry for folks who are not crypto native?
Yeah. So I think so. The venture capital structure, the traditional venture capital structure is model, I'd say, not structure, is not ideal in my opinion for crypto. And why is that the case? Because, you know, in a traditional venture model, you have, you know, you have always been investing in equities. You have your LPs that expect you to invest in equities. You have partners that have been trained in thinking in terms of addressable markets and cash flows and things, very traditional ways of thinking. And with crypto, you have new considerations, right? You have business models that are not cash flow based. You have early liquidity. You have active network participation, where you go into a network and actually become a node yourself, and you perform a function in a network, like being a Bitcoin miner, for example, and you earn more of it. So to do all of this in a traditional venture model is just very complex. And you also need kind of the approval of the other partners there that are thinking in very different terms, you know. So I think naturally you've seen some of these partners that really wanted to focus on crypto to spin out, and some of these venture funds have actually made investments in these spin outs rather than wanting to have them in-house. It's just very different ball games. Yeah. So in my opinion, I think you need dedicated funds at this stage. Now, how will it evolve over time if crypto becomes more mainstream? I don't know. But at this time, I would go for crypto native funds, where they can be unconstrained. You have to be unconstrained in a space that is so fast paced and constantly evolving.
Right. Yeah. Yeah. And even if you have you'll have hedge fund structure guys get involved in equity deals. I mean, hopefully side pocketed. And then you'll have venture capital VCs get involved in, liquid situations too. So it's sort of like there's a lot of crossover.
There is,
Yeah.
I don't know how whether folks are familiar with staking and
Yeah.
yield farming, and these are all, let's say, return enhancing activities that can only to a portfolio that can only be done in a crypto native way. You need to set up nodes, understand the blockchain infrastructure. You need to be involved kind of on a daily basis. A person who's funding the next consumer app is not going to be dealing with this.
Right. Yeah, I mean, we can well, there's definitely a lot to dig in there, but before we move too far off topic of portfolios and funds, how do you think about sizing and like its role in the portfolio and asset allocation, all that kind of stuff, since you have dealt with folks who have taken the plunge?
That's a very interesting question. And when we wrote that paper back in early 2019, we had written, don't put more than 1% of your portfolio in it, and it was kind of random, because why 1% and not 1.5 or half? But I think it depends on risk tolerance and also on how much you understand the space, right? I think.
Yeah, definitely.
Somebody that has done their homework and understand the space and the volatility and doesn't bail when Bitcoin falls to 2,000, and it just keeps a long-term perspective. I'd say 1% at this stage makes sense, because in a worst-case scenario, you're going to lose 1% over a 10-year period, let's say. And in a best-case scenario, if we can go into how big these markets could be. You could get a 10x or a 20x, and so there's an asymmetry there. So I would view it more like an option. Now it depends on whether you're willing to burn the premium. You need to be willing to lose money here. It's very risky, period.
Right.
So,
but it's the asymmetry that makes it interesting, right? We're not shooting for 1% returns or 10%.
I think if you go in there, you're shooting for 10x at least. If the venture capital, traditional venture capital is a 3x, like where people hope to get a 3x or, on average, and they actually don't get that, but they hope so. They hope to get a 3x.
Right.
Here, you gotta aim for substantially higher than that, and given how nascent and small this market is, and how many industries it could disrupt, and how many ways you could see value accrual, even just Bitcoin on its own, you should be thinking of it as a 10x over the next 5 to 10 years at least. That's kind of my perspective here. But of course, with the risk, with high potential returns comes very high risk.
Yeah,
you could lose your capital.
Right. We actually had a question pop up here about the regulatory environment, and I do think it's worth tackling. Actually, why don't I kick it off? And we've talked about this a lot, Marcos, but what gets lost oftentimes is all of the positive, surprisingly, frankly, positive regulatory headlines that have been coming through. I think first and foremost, the OCC, so Office of the Comptroller of the Currency, basically gave the all clear for banks to custody crypto for clients, which is enormous. So that's one of them. The one of the higher profile members of the SEC Commission has been incredibly positive towards crypto. And there actually was recently a guidance of sorts put out by the DOJ, kind of reflecting how they were thinking about crypto. and it's actually pretty, I wouldn't say, glowing, but they acknowledge that it's here to stay, and they have to think about how to deal with it. And they also don't want to necessarily stifle innovation. And just to rip the Band-Aid off, there was a recent arrest for well, I don't know how close y'all pay attention, but BitMEX was sort of like the longest running derivatives exchange, and they were shut down because they kind of more or less openly flouted non-KYC, and so they didn't have any kind of intent to comply with all that regulation and whatnot, and they were not good about screening out U.S. users of their platform. And so on one hand, it's probably not a great headline to see one of the biggest sources of price discovery and liquidity shut down in crypto, but I actually view that as incredibly positive in the sense that people are taking this seriously and cleaning up, which arguably is debatable, but arguably was a source of a lot of the market manipulation that was happening in the space. So taking that out, I think is good. A little less significant, but symbolic is the charges brought against John McAfee, who touted his sort of profile to shill a lot of pretty garbage projects, honestly. And so removing stuff like that and hopefully transitioning to focusing on the power of decentralization and the technological innovation happening. I think that's a positive step forward.
Yeah, since you mentioned the DOJ, I have to read this because when I read it, I just couldn't believe it that it started that way. The press release, a year ago, I would never have imagined. But cryptocurrency is a technology that could fundamentally transform how human beings interact and how we organize society, is what Attorney General Barr said in the press release, which is incredible. Of course, he does go on and says, that we need to be very careful for our public safety, national security, etc., and prosecute fraud. And but he starts with that comment, which is pretty powerful comment to come from the Justice Department, I think, and that's something that I don't think I would have imagined like 2 years ago when we were starting our effort, to look into crypto.
So there's another part to the question, when we would expect bulge brackets and traditional allocators. This I don't know is not a very satisfying answer, but it seems like every bank that kind of talks about crypto, it approaches it very dismissive fashion. And I think cynically it's because they're not able to make money in this space. There are no banking fees, there's no trading fees, none of their established networks. There's no way to cross-sell this. So I guess I feel like they might have to, they either sit this one out, maybe they do a few of the crypto IPOs that potentially are going to come through in the next year. But I think there's sort of a talking your own book element involved when it comes to banks and crypto.
That's great. I'm going to ask you another question, and then maybe we can open it up to for just Q&A. We've answered a few questions, but let's open it up to just Q&A. But what do you think, Andrew, are some of the key risks involved with investing in this space, and how can you manage these?
Well, I think first and foremost, we've hammered it home, but just does this work, right? If crypto doesn't work, then it's an existential kind of binary outcome. But short of that, there's also plenty of volatility, right? And that's I think the way one thinks about that is, well, you just think about sizing and kind of expected return, and that's something that you talked about. Maybe a lot of Pepto-Bismol if you watch the markets pretty regularly. But I think the thing that actually really throws most people for a loop is that the operational side is just radically different. It's a completely different series of plumbing. So for instance, I deal with hedge funds. They have prime brokers, they have administrators, accountants, and so on and so forth. You're not going to find a lot of. There are a handful of administrators that are somewhat qualified to mark these portfolios. Not all accounting practices will audit crypto funds, and then there is no prime broker in a way. And you got to think about custody. You got to think about multi-sig. How to move funds, and there are a lot of like analogs with and conceptually with kind of existing operational due diligence best practices. But it is a completely different set of service providers that you kind of have to understand, and that's kind of part of kind of rewiring the plumbing of the financial system, is that you're gonna have to build it back from scratch. And so a lot of things that we take for granted in the markets today, it's still kind of early days on that front.
That's very helpful. I'll add a few from the investment side. I think that I consider substantial risks. I think by hearing a lot of institutional investors saying I don't want to invest in Bitcoin, and I don't want to invest in Ethereum, I don't want to invest in tokens, but I want to invest in equity. It leads me to the following point. I think that at this stage in this space, it's important to be diversified, across instruments, meaning from equity all the way to Bitcoin, and diversified in terms, hopefully, if you can, diversified in terms of managers. The reason being that I think it's hard to know how exactly it's going to play out, but it most likely will play out in the following way. There's going to be maybe 6 or 7 protocols that are going to dominate the other protocols, where they'll win over network effects. Take Bitcoin for a store of value use case, or Ethereum for decentralized computing, or another blockchain for gaming. But a few of these are going to become the standards and are going to accrue all the value. In addition, how value is going to be accrued, between tokens and equity is also pretty open question. So the last thing you want to do is kind of miss out on the boat that wins, that wins the day. And you want to be, more diversified rather than less diversified, I'd say, at this stage, especially since you really don't know. Same with managers, because, even though managers, there's overlap, there's definitely overlap between managers and their positions. There's many other considerations. Managers might make bad buy and sell decisions. They might have entered crypto assets at different prices. Some might be good prices, some might be bad prices. Others might, if they're in a hedge fund structure, might face redemptions and shut down. You need to be diversified also across managers. So what I would say here is, be diversified and spread your bets so that you can, if a few of these win, you're going to be on these horses. The other thing I was going to say is that, a big risk is for people, because you have this short-term volatility in prices in the case of tokens. A lot of people might bail too early, right? If they have liquidity. I would take a 10-year perspective. So if Bitcoin was 12,000 when you entered, and it's down to 3,000, do not sell. You're taking a 10-year perspective here. Just hold on, because the worst thing you can do is just try to time these markets. And finally, you touched upon the custody risk. Again, this means, have more diversification, or with DeFi smart contract risk, for example. Again, have more diversification than you think you should here. An initial glance tells you that there aren't that many protocols or businesses here. And many managers have the same, a lot of overlap, but there are all these other considerations that you should take into account.
Guys, that's great. I've just got another quick question. Just, talking about institutions, obviously you both come from institutions, right? How are you, what's the conversation like internally when you talk to your CIO about crypto and Bitcoin and venture funds that are investing in the space. You know, and then also as I know you're probably not at a lot of conferences right now, but when you're talking to other institutional investors, what's their thought, right? Are they thinking about this the same way? Or are they kind of scared or nervous? Are they making investments?
Should I start, Andrew?
Yeah. Go ahead.
Yeah, I've lived through that quite a bit. I'd say that for a CIO and for people in the traditional investment world, it's a tough one, right? Because the last thing they want to do is have career risk here. Like, say, you know, you recommend to a client to invest in crypto and it goes to zero and they fire you. You know, that's the last thing that you want to happen. But if you do educate your clients, and if you do get them on board by educating them and make sure they're comfortable doing it, then you can mitigate that risk. I would say, though, that discussions have been difficult over time and have been slow. But there are many people who have, you know, over time understood that there's something going on there that's interesting. I think versus 2 years ago, it's a huge difference. So that career risk has gone down, especially as more institutions have been investing. So long as you, as I said, Joe, if you view this as an option and you invest as if it is an option and you understand that, then that's all you need, in my opinion. Do your homework, invest in it as an option.
Yeah, I mean, I probably wouldn't, probably can't really reveal all the inner workings of what's going on, but I'll just say that I've remained pretty consistent in trying to educate the team, and you know, while I don't think anyone has necessarily reached my level of zeal, you know, minds have been opened, and so, you know, one of the things that I constantly get asked when I talk to crypto funds and managers is like, oh, well, you know, when are institutions coming? When are institutions coming? I mean, I can only speak for myself, and I think this is again an unsatisfying answer, but I think one of the ingredients is just time, and the kind of repetitively updating and kind of socializing the idea internally. That's just, you know, that's just what you got to do. In terms of what other folks are doing, just very broadly, I've noticed that a lot of the endowments have gone in fairly early, and I think and so they got on the train probably back in like 2018 or 19, if not even earlier. But I think, like, from the pension side, I get a lot of weird looks. I haven't really talked openly to a lot of, but maybe now, just kind of, it does seem like it's, and I think it helped with you know, Paul Tudor Jones making a very high profile, frankly, announcement that he put on a new position. And, you know, you can ask questions about what his motivations are for putting out that 10-page thesis, but nonetheless, it's out there. And, you know, it's like, if you don't want to listen to the nut job of the investment team, maybe you listen to a billionaire. So that's kind of what I've seen from my vantage point.
There's a question that's that I see here about private crypto assets and currencies and central banks as they enter, and that's a very interesting question. I think my take on it is that they can coexist for the reason that you know, central bank currencies would be kind of a more efficient way to operate a currency, right, which would solve a number of these problems in the current system. So for sure they would get let's say market share from crypto, but I think crypto is really broad. You know, they're all different types of assets, from work tokens that allow, you know, suppliers on a network to earn fees, to governance tokens, to Bitcoin, which can be, you know, a hedge against the traditional financial system. I would say, my initial take is that the stable coins would be most at risk with respect to central bank releases. Libra, perhaps not something like Maker, which doesn't have any collateral, which is purely based on smart contracts, and that's kind of makes it a very different sort of stable coin. But that's what I would say. Now, it's very hard to quantify it, to say, is it going to kill the crypto industry? I don't think so. I think they can coexist, and I think the crypto, part of the value proposition of crypto is that it can be permissionless and allow people to innovate on top of it. So I think that's not going to go away. That's my 2 cents at this stage. We'll have to.
There's also, it's like central bank digital currencies. I think the only one of scale right now is frankly in China. And there's talk of a Fed coin, but there doesn't really seem to be motion. China's been working on central bank digital currencies since 2014, more or less, or at least researching. And now we're kind of getting in motion. Maybe taking a little different angle from Marcus. I actually think that we may not even need a central bank digital currency if some of the stable coins just act as wrappers to US dollars. So Libra essentially becomes just a digital version of the US dollar that can exist anywhere in Facebook's network, which is pretty powerful. That's 2.4 million users. So we may not necessarily need a Fed coin, but there are sort of in kind of a similar vein of how there were euro dollars. Now we have crypto dollars. I took that from Twitter. So credit where credit's due. But there's also a very kind of fundamental question of control and surveillance. So that's one thing that might give civil libertarians and folks the heebie-jeebies if basically imagine a world where every single one of our transactions was known by the government. There's some, if you look at it from an abstract perspective, there's a really powerful way to understand how the economy functions. But let's not be let's not kid ourselves that that's a massive invasion of privacy. So I think there's going to be, and crypto kind of sits in, if you want to get all kind of epic about it, it sort of sits in that battle. I think Stephen, you're on mute.
Yeah, thank you very much, Andrew, Marcos. Great discussion. What concerns you from the regulatory potential regulatory changes coming your way in this space, and how do you think about that?
I can, or Marcus, do you want to kick it off?
Sure. Yeah. So regulation here is always a big unknown, but my perspective is that regulation will evolve to accommodate this space, and I think it's very important that this space and regulation come together at some point. There's definitely going to be a compromise needed here, but I think it will be very important for the space to flourish over time. Now, regulation needs also to adapt. It's very hard to shut down Bitcoin. I think there were a few people that were saying like a few years back, we're going to shut down Bitcoin, but you can't. You can't shut it down. So what you need to deal with that reality and create rules that accommodate that reality. I'm not scared. I think it makes it even more uncertain and rockier as a path towards investment returns. But I'm not worried about it. I think that over time it's a good thing. In the same way, I'll give you an example. It's not related to regulation, but when Mt. Gox happened, people thought that Bitcoin was going to die. It's the end of it, right? There was this big fraud and the collapse of the big exchange. And in fact, the fact that it got out of the way and you had exchanges like Coinbase, professional exchanges develop over time, has only strengthened the crypto market. right? It not only did it not kill it, it cleansed it from bad elements and shaky ground. So now with that, there could be overshoots in regulation that could, kill certain projects or create a ton of volatility in the interim. But I tend to be an optimist here.
I would, to kind of continue that thought, there is also a potential scenario where if we do overshoot, or if regulation is either too onerous or just too ambiguous, basically all these projects go abroad. And you start up in Singapore, who's created a sandbox approach. You start up in Switzerland. You start up in just more permissive legal environments, and Americans and America gets shut out for most of the gains. I mean, I guess that's where VPN comes in, but there's a non-zero chance of that happening, which I hope doesn't happen. And it seems like the recent movement on the regulatory and legal front is, I'd never say like great, but at least like moving in a direction that is a little bit better. But that is, regulation is sort of the overhang for a lot of US-based crypto projects.
Let me add one more thing. There's been all these waves of regulation that people thought would kill the industry. Most recent one was the ICO situation, right? Well, 2 years later, now we have a much better version of the ICO world, which is DeFi. What I'm trying to suggest is that, these things will evolve and they'll get stronger, and the regulation will get more in line with what's going on, and they'll move together. Maybe not in parallel all the time, but they, the path so far has shown that that the space has only strengthened, over time.
Thank you, guys. Great presentation.
Thank you. Thank you very much,
Thank
everyone.
you.
Yeah, guys, we're at the hour mark. So, at this point, unless there's further questions, just wanted to say thank you, Marcos, Andrew, really appreciate the time, everybody else. And, obviously if there's follow-up questions, or if people want to see a copy of the recording or any kind of highlights, obviously just kind of get in touch, and happy to kind of facilitate an introduction if it would be helpful to anybody on the line. But just saw one more comment come in from Bill Deutschler, who I know has done a lot of work in the space.
A long one.
Yeah, it is a long one.
Typical Bill.
If Bitcoin achieves much wider adoption, then you could have a very interesting situation where you could have a global currency without inflation. I guess that's one of the kind of key attributes as to why it's so attractive, right? When you're living in a central bank environment that just continues to print capital,
Right.
having a control over the inflation and decentralized, ability. But Bill, I don't know if there's any last comment you want to touch on. I know you've done a lot of work in the space when you're over at Morgan Creek as well.
Yeah, no, it's Marcos. It's great to see you.
Hey, very nice to see you, Bill. How are you?
Yeah, doing well. And Andrew, we had connections through Anthony, but never had the pleasure.
Yeah.
So no, I mean, it's such a great panel. You guys did such a super job and a lot of points, very important, were touched upon. I guess as a closing thing for me, one of our biggest clients when I was at Morgan Creek was Fairfax County, and they really ran the gauntlet of the due diligence, the fire from the outside, a lot of contention, both from their constituents as well as from the board and other parties and things like that. I think at the end of the day, much of the points that you guys have made is that looking at the diversification for their portfolio, they felt as though investing in this brand of innovation was worth it. And the potential asymmetry of the opportunity, both from a venture standpoint as well as Bitcoin itself, was worth the risk in many dimensions. And clearly, they sized it appropriately. This is pretty much public information, so I'm not giving away anything, but their first allocations were on the 50 to 70 basis point level. And, subsequent follow-on investments, I think, have taken them up closer to 2%. So that's, that's pretty meaningful. But at the same time, if it zeroes out, it's not great, but it's not going to be the end of the world, for them. But at the same time, you guys were talking about, what do you underwrite to? And, I had any number of conversations with institutions, and they would always ask me that question. And I would very sheepishly sort of say, well, maybe 5 or 7x. And they'd look at me and go, how about 10 or 20? Does that sound about right? Look, I couldn't say that. I couldn't say that without prompting. So, that's the kind of thing. I mean, it's elephant hunting in a different way. And, to make it worthwhile, for institutions, I think that's what you kind of have to shoot for. Now, again, whether you get those kinds of results, who knows? But the other aspect of it in terms of an asset allocation play is that you are getting in very early stage for a lot of these companies. So, you have the maximum potential of the power law, operating in your favor. So once again, I think, if it's interesting and you absolutely need to do your homework, you guys like hit it on the head. It's totally different. The whole infrastructure thing, totally different. But if you want to spend the time to get into it, then, you've got the opportunity, for these types of returns, sized appropriately, it sounds good. I think that, Bitcoin and other coins, kind of the same thing, but you absolutely have to go in with your eyes open and be prepared, for total losses. So, but that's, it's a very interesting odyssey, talking with all the institutions and things like that. So my 2 cents.
So Bill, based on your comments,
I'll try to reach out and we can catch up.
Absolutely. Absolutely.
Based on your comments, are you a Bitcoin maximalist?
Actually, no, I'm not a maximalist. I don't think it's going to take over the world. I think, I think that's a big stone to carry uphill.
Right, for sure.
For that one. But
sure.
I do think that there are a lot of really interesting applications, and it's just going to grow. It's just going to grow.
Cool.
So my one question is, where do we want to take this discussion and the ancillary avenues that were touched upon? Each one could be an event in some ways. Even Bill's question.
Yeah, of course. I mean, obviously we've got a lot of interest in the topic within our network. And so, I mean, I think we had kind of discussed maybe opening up a broader kind of, one-on-one series of this kind of conversations, but, not really sure at this point, how to approach that. I don't know if you guys are, obviously it would take, there's obviously a lot of intel and knowledge around this topic from GPs, from LPs, there's a whole ecosystem that is, emerging here. And so I do think there's a way to kind of build, and I had mentioned this to Marcos recently and Andrew, to kind of say, hey, I think there is probably a way to kind of build more of an institutional perspective series on, how institutions are thinking about this. Because I think over time, there's just going to be more and more of them, like a domino effect, that continue to kind of dive in and learn. And that's the kind of thing that I think you had kind of talked about was, when you jump down the rabbit hole, there's this kind of like aha moment when people kind of just get it. And then, it becomes this thing that they're very focused and interested on. And so helping to kind of evangelize folks and help them to kind of open up their eyes and see an opportunity. I think it just takes more conversations like this. So yeah, I would say I'm totally open to doing more of this, and I would kind of almost put it in Marcos, Bill, Andrew, and Dominic, and others who kind of are focused on this space to kind of, if you guys would like to have a podium and be able to educate further, we would love to have you.
Joe, I think it might be interesting if we could do something on how blockchain is being used to lower cost inside companies and how the technology is changing business processes, which is less clear than the coins, but I think going to be one of the more powerful uses of the blockchain technology to redesign processes and even parts of industries that are going to be able to lower cost and deal with a lot of issues. So I'd love to hear a segment on that at some point.
Mm-hmm. Okay.
It's funny on that point. Marcos had and I had talked about, and it's we went straight into sort of decentralization and tokens, and I do think that, you know, for many years it was there was the whole what do you call it, blockchain not Bitcoin kind of approach to things, and frankly, like for a long time that's how I felt about it as well. But also confession, like I didn't really spend much time digging into it. I think the space definitely the use of blockchain, enterprise blockchain, sometimes is frankly derided in sort of like more hardcore crypto communities. I think the applications are less sexy, but there can be sort of processes and efficiency improvements. But just speaking personally, I think the more transformative impact will still come from the decentralization aspect.
Yeah, have you heard of a company called Axoni?
Yes, yeah.
Stephen, they would be pretty interesting to kind of chat. I know the CEO I know pretty well. They're basically, they got investment from Goldman Sachs and all these other large financial institutions, and they're really disrupting how financial institutions utilize blockchain and incorporate that into their into their operations. So yeah, I totally agree with you. I think that would be a great topic. So let me see if I can pull something together there.
And what do you think, Andrew, are the R3 group, and they have a spin-off fund? I just happen to know their general counsel.
Well, I mean, see, the difficulty with approaching it from that angle, you know, you gotta get everyone to agree on standards, and you gotta get everyone to agree to shift to something new when the existing kind of approach still kind of works. Like there's a fear of if it ain't broke, don't fix it, and so that's kind of what I was thinking earlier when I was saying, you know, a lot of, if you can find crypto native applications, basically there's no other way to do it except through crypto networks, and kind of building from there. I think that's where you might kind of see the biggest impact, because you're also sort of having to innovate, cannibalize yourself a little bit, and you know, it's one thing if you don't already have existing rails. That's kind of a term used in terms of either settling trades or sending payments. But if you upend that and something goes wrong, then all of a sudden, you know, we can't settle CDS, right? And that's a really big existential risk that is hard to price, but it's pretty nasty. So sorry, I kind of went off on a tangent, but like I feel like I haven't had an update on what they've been doing, but it seems like they've been trying to work through stuff for quite some time.
Good points. Well, I just threw on the screen tomorrow, if you're around, that we have, as part of our program, we do these breakouts once a month. So there's a fintech breakout as it is. But kudos to you, Joe. This is a great way to kick off the vision of having this series.
No sweat. Thanks so much, Andrew. Thanks, Marcos. Thanks, Bill. Thanks, everybody, for participating, and hope to see you guys again on the next one and tomorrow on this fintech.
And Bill, you know everything. Like, I'm going to have a cannabis breakout. You're going to have like a 5-slide view on cannabis too?
I'm tapped out on that one. Sorry, I'm not the total Renaissance man.
Jack of all trades.
You were deflating my huge balloon. I was envisioning you as.
I got to let some of the air out.
Hey, thanks for speaking on Kissinger earlier today too. That was great.
Yeah, you're welcome. Thank you. Great job today.
All right. Thanks, everybody.
Thanks.
Cheers.